Hi, everyone. Welcome back to Capital Consumption Theory. I'm here with Brian Winters, and today we're going to talk about many different topics, and we may have Austin Mackle joining us later, if he, yeah. So Brian had a topic which you were discussing on a Twitter thread about what was the topic, Brian?
So Jake Snyder had a question. He was curious about what the percentage of money circulating in the economy originates from private debt, like bank money, as
Yeah,
opposed to from government spending.
right.
Uh, and so I don't know. I wondered if you had any sense of that or how we could
Okay.
figure it out.
Yeah, I do. That's a good question. Um, there is one thing that I want to say about the question. So the way it works is that you have the base money. So Perry Merling's money view, and he has I think it's a Coursera course, online course, free online course about it. Um, Talks about this, and that's very good stuff. But in a nutshell, the money in the economy, you can divide it up into base money, which is Federal Reserve liabilities, and um, I guess like private money, like bank money. Um,
And
so
so the Federal Reserve liabilities, is that essentially the national debt?
no, it's not the national debt. It's different from the national debt, completely separate. So the Federal Reserve liabilities are basically um, you can think of them as bank accounts for banks.
Hmm.
So when we say liability, it is a liability of the Federal Reserve. So it's like if you take $100 and you deposit it at the bank now owes you $100. So the bank has a liability for $100 that they owe to you. Whenever you want to go to the bank and ask for that money back to pay for gas or whatever.
Yeah. Sorry.
So,
Is it roughly equivalent to the national debt, or it's completely
no, it's
unrelated?
completely
Okay.
unrelated, completely different stuff. And um, I want to say that there is a little bit of sort of how can I put this? I would say confusion. There are some conclusions of MMT that I agree with, particularly the idea that we are underrunning the productive capacity of the economy. But there's a lot of stuff that
You
some of
you
it
should develop some sort of theory along those lines, Eddie.
right, right, absolutely. Um, um, yeah, that would be CCT, and
Yeah,
the book will be coming out very soon. The table of contents is already finished. You can see it on my
there
Twitter.
you go.
But
A book of 1,000 pages starts with a table of contents.
exactly, exactly. Um, so the confusion, some of the confusion. So there's some confusion out there. So let's just talk about what's so the national debt is completely different. So the Federal Reserve liability, that is the base money of the economy, and it's basically like a bank account at the Federal Reserve. But not anybody can have an account. Mostly other banks have accounts at the Federal Reserve. The Treasury Department also has, so the government also has an account at the Federal Reserve, if I remember correctly. But the liabilities, they're like a bank account. So um, you know I mean that's all they are really is an account. They're like a ledger. It's as if it's like a book where the Federal Reserve records, okay, Chase Bank has you know $100 billion in their account. Wells Fargo has $150 billion. That's the base money of the economy. And what happens is that what you have at Chase Bank. So when Brian Winters has an account at Chase Bank and he has $100 at Chase Bank, that is a Chase Bank liability. So the Chase Bank has, owes you $100. They've agreed to pay you back that $100 in the future, which you've put in, to the account sometime in the past. Chase Bank can create liabilities. In fact, you and I, we can create liabilities also. So if today I said, you know what, I'm in just a great mood, Brian, and you know what, I'm just gonna promise you $100. You've got $100. I owe you $100, Brian,
Okay.
because I'm just really happy and I just really like you today. And I can do that. And if I good good for Brian. And if I keep my word about that, then you, in a very real sense, there exists an Eddie Chu liability that is owned by Brian Winters, that Brian Winters can claim $100 from me. Hey Eddie, remember last week you said you'd give me $100? I think I'd like it today, please. Right, the liability, your own liability, you can create that at will, and the banks can create that at will. So most likely, a most likely scenario might be that you say, I am buying a house for $200,000. I'd like to borrow 100,000, and Chase Bank says that's fine. We'll sign this loan agreement, and you'll be paying it off in the future over time. But we are putting into your account, Brian's account at Chase Bank, $100,000, which will then go for paying for the house.
All right. And so then that liability, that money that they're creating
Yeah,
is private money, is bank money, and
yeah,
is
it's
not
private money.
sourced from government spending.
Yeah,
Right.
it's bank money. To be clear, no money, like MMT says that money is spent into existence. That's basically just not true. That's actually false. That's actually just not true. Yeah, the government does not spend money into existence any more than you or I or other businesses or banks. The spending of the government, for the most part, works the exact same way. They can borrow money. The Federal Reserve is the one that creates the base money. That's the way it's set up. The Federal Reserve can create base
But,
money,
but
and
the
they
way
do
that it
that for
creates
money
it
as
is
well.
it spends it or borrows it into existence, right?
No, actually, the way the Federal Reserve creates money, is that, so the Federal Reserve, operates in debt markets. So, they will go out onto the market and they will buy financial assets. Like, it used to be treasury bonds, but now with QE, they also buy, mortgage-backed securities. Um,
And
and
what are they
and when they
buying it
buy
with?
something, that's the exact right question. What they're buying it with is their own liabilities. So it's exactly the same as when I said, Brian, I owe you $100, and suddenly, like, we just created out of thin air $100 worth of Eddie Chu liabilities.
Uh-huh.
That's what the Federal Reserve does. They
And
just they go to their account, and the person who sells the bond
right.
to them hands the bond to the Federal Reserve, and the Federal Reserve goes and writes down on their account and says, okay, you gave me the bond. I now owe you. You now have an account. In your account, you have an extra, $10 million for those bonds that I just bought off the
And so
market.
what's the distinction that you're making, that where you object to the idea, to saying that they had just spent that money into existence by spending it on the purchase of the bond or whatever?
Yeah, well, I mean, you could say that, but that's confusing, and it's not what most MMTers are talking about, because the MMTers are usually talking about spending into existence, like the government wants to pay their light bill, or they want to buy a tank or a bomb,
But
or a
how is that
or
any
build a
different? How
post
is that
office.
any difference? If your bomb that we're going to
Yeah,
sell to Saudi Arabia to blow up a school bus full of children
yeah,
costs $1 million,
yeah.
and they say, all right, here, we're just going to mark up $1 million in your account, aren't
Yeah.
they just spending it into existence?
Well, it's different because the government, which spends money at using the treasury account, um, they are not allowed to create money. Only the Federal Reserve is allowed to create money, and the only
And the only reason
reason
they can do that is because Congress gave them the authority to, right? Congress is the one who has the power to
yeah,
create money,
that's
and
true.
they've delegated it
Yeah,
to the Federal Reserve.
yeah. But the distinction here is that the Federal Reserve does not go out into the economy and just spend money into existence, like, let's have more post offices, more that, let's hire a bunch of people to do this and that. They are chartered, so the way the system is set up, the only thing that they're allowed to buy is debt basically, and their purpose, the purpose for them to buy the debt, the idea is that they are controlling the money supply to influence interest rates to regulate the economy. That's the reason for that supposedly they do this.
Yes, because they have as part of their mandate to maximize employment as
Exactly.
opposed to minimizing poverty, which would be
Right.
a much better mandate for
Yeah.
them. Okay, but going back to the original question, so
Yeah.
how much of the money in circulation is a result of the Federal Reserve spending it into existence, or whatever, however you want to describe it, versus
Yeah.
a bank spending it into existence and saying, all right, Eddie, here's $100,000 towards that house that you want to buy,
Right.
creating it that way.
And again, the bank doesn't spend into existence either. The bank just loans it into existence, but they don't spend it into existence. Not for spending,
Okay,
just for
all
just
right.
for
I can see the okay, I can see your distinction there.
so so to figure that out, you would go and look up what is the broad money supply, and that is a figure that basically looks at all the bank accounts in the whole economy and just adds them up, and it says, this is the broad money supply, this is how much money people basically have at the banks. You take the broad money supply and you divide that by the base money, which is the liabilities of the Federal Reserve. I think the liabilities of the Federal Reserve is about 8 trillion, and the broad money supply is about 20 trillion. So it's about 3-1. But again, I think I think the thread, I would suspect Jake Winters and you guys were looking have a question that is sort of a little bit larger and more significant than that has more to do with spending. And there's a little bit, I would say, of a false assumption there that the
All right.
spending really has that much to do with the supply per se.
All right. So, Austin, just to bring you up to speed and welcome. So we're talking about how to figure out how much money in circulation comes from government spending and how much comes from bank spending creation. And so Eddie's described how to figure out the government liabilities, and now he's going to tell us how do we figure out private liabilities.
Oh, that's the private liabilities. I mean, it's just the big. I think we should actually move on because Austin had some stuff that he wanted to talk about also. But if there's a burning question, if there's
So
anything.
you just described, you gave us the rough numbers of how to figure out what the federal
Yeah.
money, how much that
Yeah.
is. How do we
Yeah.
do that for all the private banks? How do we figure out how much they've put into existence?
They just go around and the economists, they just go around and they add the numbers up. But I think maybe the question is sort of like, what does that mean? Is that sort of the question? Yeah.
Yeah, the original question was sort of like, what's the percentage? Is it like 90% private money and 10% government money, or that was kind of the original question.
It's about 3-1. It's
3 to
about
1?
2-1. It's about 2-1. So like a total of like say 1/3 of the broad money supply is base money makes up about 1/3 of the broad money supply, or is like a 1/3 ratio to the broad money supply.
All right. Well, I don't have any better information, so we'll call that question resolved for this week, and then let's see what Austin has.
It's an interesting. I think the one thing I want to say about this is that uh, I posed this question to my mom as a kid. We were going to a bank and withdrawing money, and I said, where, and I watched her putting the check into the tube, and then the tube goes, sucks up, and it's a drive-through bank, and it goes into the bank, and then they send cash back into the tube, and you send a cash check in, and you get cash back out. I said, where does the money come from? And she goes, it's from our bank account. I said, but where does that come from? Oh, dad earns the money. I said, okay, but and the companies earn the money that dad earns and pay to dad. But I said, but it has to start somewhere. Like, where does it come from? And she didn't really have a good answer to that. The answer to that is that, it starts off, at the federal bank when they write down in their account, 100 million more dollars for Chase Bank, for the bonds that they're turning over. Yeah, and in a nutshell, that's it. So the Federal Reserve is tasked with controlling the money supply so that it does not have, so that you don't have inflation, and hopefully they want the economy to run well, and you don't have lots of unemployment like you had in the Great Depression. And that's how they do it, by controlling the money supply. But the place that they put the money into is they put it into the debt market. So if the Federal Reserve did not exist and we were still using gold as money, there would still be a debt market, and the debt market would have a market interest rate. So what the Federal Reserve does is they go in and it's as if they have a gold machine. They pump more gold into the market using it, and what you end up with the larger supply of money is you can bring the interest rates down when you increase the supply of money. Yeah, so that's how it's set up. That's how it sort of works.
Yeah, and that's why
That actually leads into a little bit of what I want to talk about today, which is the difference. One of the core differences between CCT and standard economics. Standard economics says that at some point economists decided that Keynesianism was applicable to the short term, so that you have recessions, but they decided that classical theory still applied to the long term, and that in the long term, supply and demand are in equilibrium, and there is sort of like an unstated assumption there, is that it's an optimal equilibrium in some sense. So in the standard macroeconomic view, in the long term, the equilibrium is controlled by interest rates. And so the way it's controlled by interest rates is that, if you think about the whole economy, everybody in the economy as sort of a household, people make a decision about whether they want to spend money or whether they want to save money, right? And when they save money, then the money that they save, even if they don't invest it directly, it will sort of go through the bank and through the financial sector, and it will be lent to somebody else who will invest it. So the standard economic idea, does that make sense?
Well, it's not so much that their money is lent to other people as much as it's a reserve so that a percentage of it can be lent out.
Yeah,
right?
well, there's a reserve multiplier there, because the banks, even in excess of the money that people are depositing into the bank, they can actually lend even more money out. And the reason they can do that is because as soon as they lend the money out, people put the money back into the bank.
Mm-hmm.
Right? They lend you the
Yes.
money, and then you put it in your bank so that you can spend it tomorrow. So
Yeah.
and then when you
that house that I just sold
somebody else puts it back in the bank again.
Right. Yeah.
Right. So the bank has this very interesting ability where because all the money goes back into the bank, because they're the people who are the institutions that are trusted with holding people's money. They can get away with that. They can get away with lending money out, which is in excess of their net assets, far in excess of the net assets that they have. And they can do that because they don't have bank runs, because people don't all of a sudden panic and say we're all getting out of our money out right now, because if they did that, then that would, it wouldn't work. The bank would run out. But because they don't have bank runs, and you have insurance to make sure they don't have that, that is sort of, that whole system more or less works.
Yeah, so I've been reading Ages of American Capitalism and taking a few notes in it. And they're talking about the Second Bank of the United States, how it typically issued, $2 for every $2 to $3 for every dollar that it actually held in hard currency.
Yeah.
So that multiplier has has changed over time.
Yeah.
But
yeah,
bank
absolutely.
runs used to be more of a problem, I think, than they are today, where so much more money is digital.
Yeah, absolutely. Absolutely. And the funny thing about it is that that it works as long as the price of money stays stable and you don't have large panics about the price of money. Then you end up with this sort of accounting system where you can think of it as tokens being just passed back and forth between people who are providing inputs to the economy, and at the same time taking outputs out by spending their money. So there's a counter current flow of money in one direction and goods and services or inputs in the other direction. I see Austin has joined us, so welcome to the discussion, Austin.
Yeah, sorry I was late. I had I suddenly had to install a car seat, like a children's car seat. Sorry, there was no one else available for it. But I've been listening for a while. I was enjoying what you were saying. It was interesting. You were saying about the government supply is something like what government spending. If I understand correctly, you were saying earlier that government spending is roughly 3%. Sorry, a third of the money supply.
Yeah, but not government spending. Base money. The liabilities of the Federal Reserve are about 1/3 of the broad money supply. Yeah.
Yeah, well, it's interesting. I mean, the question is about is the supply what matters, or supply times velocity or whatever. But really, it all comes down to spending, right? Like how many demand signals get sent to the real economy. So you can have quite a small money supply with, like, people talk about, do we want to have a redistributive or a money creation basis? Like, how do you, if you're funding a basic income or whatever, do you fund it through a redistributionary system, or do you fund it by having a money creation system? And they can end up being quite more similar than people think.
You can use both of those things together.
You've got this, or you can do them together, of course. But the end result is that you end up with more spending. So it's more about the flows than the stocks, right? And one thing that I've been thinking about a lot recently, and I think this is true, but I'm not sure, is that basically you could model the economy this way, right? You could say there's the financial sector, which has to make a profit.
Yeah.
Right. And then there's the sort of the retail economy, the actual consumer goods and services economy, right? Which, like, the real economy, the bit we care about, right? Yeah. And then you've got the government, which also provides services that we care about, but we can also just imagine it as a financial entity. And in one sense, us in the middle, the ordinary, the real world economy, we're the only people who can't really create money. The financial sector can create money, and the government can create money, but the financial sector has to run a profit. So the government has to run us at a deficit. right? Like, because the actual flow of money is overall is from the government into to the population, from the population to the financial sector. And what we see is like, if you have a period of austerity, like leading up to 2008, the whole system breaks down and the government has to transfer money directly from the government to the financial sector. There's no time for it to filter through the real economy, right?
Right.
And if we can just sort of imagine that as the basic circuit, the government is the positive charge, the bank is the negative charge, because they have to take in more than they lend, right? Or charge in fees for savings accounts, etc. But essentially, right, financial institutions have to suck money out of the economy. So therefore, the government has to push money in, or the bit between the two, which we all depend on, dries up.
So I'm going to have to resist sort of talking too much about money, and especially sort of the MMT view of it. But I want to try to get back to the topic of so
Well, that's what I'm saying is different. What I'm saying is very different from MMT, I think, right? MMT just sort of say it's okay, it doesn't matter. That the government, it doesn't have, MMT doesn't have they do talk about want to have zero interest rates, right? But I would say no to that, right? I would say, no, we don't want zero interest rates, because then you have the one reason to have interest rates, and also I think minimum wages and stuff, and stuff like that, is because you're setting a minimum speed limit. Like on a freeway, you can't drive 10 kilometers an hour.
So,
right? So we want to have the same thing, that if you want to be using up the economy's bandwidth, you want to be on the roads, you want to be in buildings, you want to be using up manpower, you got to be moving at a certain speed, you got to be making a certain amount of profit, and interest rates are one way of doing that. So the bank is like the shark swimming along behind the school of fish, and when one of them's too slow, the bank eats them, right? And that's not a terrible thing. That pushes that keeps the economy stable. But what we have at the moment, with really low interest rates, is the worst of capitalism in terms of the speculative frenzy, and the worst of communism in that the inefficient businesses don't get punished, right? Like they're just too big to fail, and that's even like retailers now and shit, Anyhow.
The low interest rates are not what we want. And the question is, like, why do you get the low interest rates, and what do they represent? So again, the standard macroeconomic theory is that you have consumption in the economy, and you have investment, C and I. Those two are you also have government spending, but I'm just going to put it to one side and not worry about that for now. But you have consumption and investment. And the standard economic theory is that the interest rate sort of causes these two to equilibrate. So if you have higher interest rates, because the Fed set higher interest rates, then you'll end up with more investment. If you have low interest rates, you'll end up with more consumption. And the thing that standard macroeconomic theory misses here is that the sum of consumption and investment, those can also be sort of too low. Like you could actually potentially have more of both or less of both, and that is just sort of ignored, assumed away by standard macroeconomic theory.
So the way that I look at interest rates is that you want to increase the money supply, as the population grows, as the economy grows, the money supply needs to grow as well. Yeah. And so the way that you do that is by keeping the interest rates low, you encourage people to borrow money into existence and grow the money supply that way. And that has caused the problem where, for the last 10 years, the Federal Reserve and the Central Bank of Europe haven't been able to meet their inflation targets because they can't persuade people to borrow enough money into existence to grow the economy the way that they want. And that's what, because we're doing money backwards, we should be creating the money directly instead of creating it through debt. and
That-
distributing it
that's
to
very
everyone.
good. That's very good. So the standard economic theory is basically looking at one relation between consumption and investment, where if you have higher interest rates, then you get more investment. If you have lower interest rates, you get more consumption. And so standard economic theory looks at sort of the balance between those two. But there is another relationship which needs to be considered, which the standard theory fails to consider, which is that investment depends on consumption. You have to have enough consumption to to justify a certain level of investment. Does that make sense?
Sort of. What about like bridges to
Because
nowhere and things
investment-
like that?
Yeah,
was
but
that?
look,
What about like
Because-
bridges to nowhere? If you spend $100 million building a bridge in Alaska
Yeah.
that only 3 people are going to drive on a day,
Yeah.
even
then
though
the
the
government's-
consumption is low.
then
Go
the
ahead.
government's being the consumer in that position, in that analogy,
Okay.
right? The government's being the consumer. And I think I think that what Eddie's saying is right, but I think it's important to say, like, we couldn't just fix this by, for example, increasing consumer credit, which is what some people have tried to do, right? So what say, like Jeff Crocker and other people have done is like shown that, wages are not enough to cover the consumption bill. Yeah, that's right. So that there's this gap, and we've been using credit to fill it. But what someone like Steve Keen shows, right, on the other hand, is that the debt always chases you down. So private debt creation, in order to continue economic growth, the rate of the amount of money being lent has to keep increasing, right?
Right.
And it has to keep increasing at an increasing rate, right? So you get this what he calls which drives you back to sort of a Minsky idea of, the fundamental instability of capitalism is upward. So you get this debt fueled frenzy followed by a crash, and we keep cutting interest rates to postpone the
Let me
Minsky
talk
moment.
about that. So
Yeah.
one thing you said there is really correct. I really agree with that, which is that you have this. You're sort of trying to drive activity through debt, but there's actually a limit to debt also, because the thing about debt is that it has to be paid back. You can borrow $100 and spend more today, but with the way debt normally works, at some point in the future, then you have to pay back $100.
Well,
and
you
spend
you
that.
say that, Eddie, but we have a $28 trillion national debt, and it's not supposed to be paid back, right?
Right.
That would crash the economy if we sucked all that out and tried to repay the national debt.
Government debt is different. Government
Let me-
debt is essentially money creation, I believe.
Okay. Hold on. Let me finish that thought. And so Austin was saying that you have to create what Austin, you said it so quickly, that you should be putting more money into the system. But the thing is that at the same time, the Federal Reserve is also putting lots and lots of money into the system. They're also doing lots of money creation. So you have debt creation and money creation, and so the big question is, why is none of this working? Because you have the debt creation, and that there's a limit to that. That makes sense. And not only is there a limit to it, it's a little bit unstable, because sometimes everybody sort of gets worried about the debt at the same time. They all try to repay the debt at the same time, and then you get a crash in the economy. But the Federal Reserve is also putting lots of more money into the system, and that is sort of becoming more and more ineffective also. So I wonder if either of you guys have an idea about why money creation is also not working in the current system.
Because it's going to the wrong people. It's what I was talking about before. The money, if redistribution and money creation can be similar, right, and upwards redistribution and money destruction are basically therefore similar as well, right? So when money's created at the top, it doesn't have much effect. That's like what my lefty buddies don't want to hear is that the limit on spending isn't what's getting ferreted away in tax havens, because that has little inflationary effect. If you want to go after that for justice reasons, that's one thing, but it's not actually going to change the amount we can spend very much. And for the same reason, this money creation going to banks and financial institutions, all it's doing is bidding up asset prices. So we have a situation where people's houses are now increasing by value every year by more than the salary of the people who lives, like that, more than one salary of the person who lives in that house, right?
Yeah,
So there's an insane runaway
absolutely
asset bubble.
the right idea. The problem with the money creation is that it's going to the top. It's going to the top, and the wealthy, the capitalists, um, they invest. They don't consume. This is another distinction that standard theory sort of ignores, and as a result, it's not able to really understand and explain what's going on in the economy. Um, Standard economic theory tries to look at the participants of the economy as sort of a monolith, and talks about, for instance, consuming versus saving and investing. And if this was sort of one, you know um, sort of one what is the word, homogeneous population, that would be a good analysis of how it works. But in reality, if you look at the data, what happens is that you have a class of wealthy at the top, and they do all the saving in the economy, and the bottom 90% don't do any of the saving, and they do most of the spending, they do most of the consumption. All of the saving and investment occurs with the top 10% or top 5%.
Yeah,
And
it's
so the
roughly
problem,
10% of the people in America own 90% of the stocks.
yeah, yeah. And so the problem is that when you create the money and it goes into the hands of the wealthy, the thing is that they already have all their consumption needs fulfilled, so it does not increase consumption. And all the 90% at the bottom, they're still starving for consumption rights. They're still starving for money. They can't consume because they don't have money.
See,
And so that goes back to this.
can I just jump in really quickly?
Yeah.
Yeah, please. So like, then you've got the argument that, okay, so it's a good thing when Bill Gates buys his $500 million yacht, right? Because he's hiring all those engineers, and he's giving jobs to all these people who can like polish the knobs and whatever, and work on his super yacht that he's decided he needs, right? And Jeff Bezos can fly to space, right? Or not really fly to space, but go very high in his rocket, right?
Yeah.
And of course, and the thing is, the situation is so messed up that it is actually better when they do that than if they didn't. It's actually better for them to spend than they didn't, because there's so much latent capacity in the economy and so many people looking for work, right? Whereas in a sane economy, it would be bad to be wasteful. We'd be running near at what we could safely produce. We'd figure out what can we produce without destroying the planet or whatever, and try and increase that amount. And we'd be running close to that to give a lot of people stuff rather than to give, and their spending would actually be having pulling resources away from the needy. But that's not the case in the current system.
Yeah, we have severe underutilization. So the thing that standard theory ignores is that your investment requires some consumption, and the consumption has to be mostly done by the worker consumer, because that's most people. Most people are worker consumers, and so that besides the part where you need savings to invest in a sense, you also need consumption in order to invest. If you don't have people buying the products of a factory that would be built, then you cannot build the factory. That is the other link which theory ignores. And as a result, what you have happening is that with not enough consumption, you have underutilization of the investments. So investments cannot happen, not because people are not saving, but it's actually, you actually have the opposite. You actually have too much savings relative to the consumption and the investment which the economy can generate.
All right, so if the new money that goes to the people at the top, if they save it as opposed to spending it for consumption, if that same amount of money was redirected to the bottom of the economic ladder, where people would spend it, consume it, would that drive inflation more? With that same amount of money, putting it at the bottom instead of at the top?
No, it would not drive more inflation because you have again, you have underutilization. So what's happening right now is that it's stuck in savings of the wealthy trying to be invested, but it cannot be invested into real assets because there isn't consumption to handle that. So if you put the money into the consumer worker and allowed them to consume more, what would happen is that the utilization of all the factories would go up, and this excess of savings would actually be drained away into real investments. Like you would actually be building more factories. You'd actually be doing more automation, um, more investments in order to that you would be able to do that because you would have demand, which would justify that investment. And at the same time, the extra demand, the other part is that capital and labor, as factors of production, they're sort of in the same boat. So that at the same time that the capital is sort of getting idled by a lack of consumption, labor is also getting idled because of a lack of consumption. And the way that labor getting idled looks is that because there's not enough demand in the economy, you have a relative lack of jobs, but people still have to work to survive. So what happens is that they have to accept whatever, it goes down to the bottom of the barrel basically. Whereas if you had a great deal of demand, you'd have investment in automation, but you'd have so many more jobs that people would be able to pick the very best of the work opportunities available. So everybody would end up in the high value jobs, and the low value jobs would end up getting automated away because labor, the price is being bid up, and so it starts to make sense to automate those low value jobs because you cannot get labor to do those low value jobs because they're not going to accept the price that you can pay for it. If that makes sense?
Yep, that
Austin,
makes
go ahead.
sense.
Yeah,
And
you have your hand up.
Yeah,
Is
yeah.
that,
No, I'm trying to remember what I had my hand up for because I was listening to what you were saying. It was good. No, but the earlier on we were talking about inflation. No, I think there would be some inflation, like there was when we came out of the pandemic. You have because the supply chain needs to move, right? Like it needs to reactivate, and that there's like a little bit of
I
friction and
don't
a little bit
I
of
don't think
inertia.
so. I don't think there would be
I think
inflation.
short term, yeah. And here's the other thing I'd say. I mean, I think there's a thing, it goes both ways as well, because as people disengage from bad jobs, there's also expenses that go away. Like maybe they can move to a different place, maybe they can have less transport expenses, maybe they can have blah blah blah, right? Um, but I think if you didn't get any inflation, you should continue increasing the basic income payment until you did. And then when that happens, you should adjust interest rates, right? Like, and that's starting today, right? With interest rates at this really low thing and this huge amount of debt in the system, or you would start with a basic income that you quickly ramp up until you start to see some real inflation. And then you put interest rates, 2, 3, like normal person, like at a level that is, makes sense for an interest rate, right? Like if you want to have inflation at 2%, then you kind of need to have an interest rate at 4%. So putting your money in a bank makes sense, right? If you want,
I'll say that
yeah.
if we put a basic income in right now, the high inflation that we're seeing, that would actually go down. The high inflation that we're seeing, and it's not, it's because it's a
It's not that
market
high and it's already
phenomenon.
going down.
right.
It's based on market expectations, which can sort of change on a whim, and there can be it's almost like it can change on a whim, and everybody can decide at the same time that things are going down or things are going up.
Okay. But like you talked
But
about a minute ago about if low wage jobs kind of go away,
Yeah.
if when I started working for McDonald's when I was a teenager, I made, 425. And if somebody's making $15 an hour now, McDonald's, labor costs have gone up, and so their prices go up, and so that's
Yeah, I don't
inflation.
think that,
And that's
I
not
don't think that's
necessarily a bad
necessarily-
thing. If
hold on.
it-
So there's
So
two
in
things.
Australia, the minimum wage is already $19, right? And McDonald's workers get $19.
Yeah.
And McDonald's is not that expensive. Like I think even like I heard someone that a Big Mac here is cheaper than there or something, right? Because there's still a lot of other fast food chains and they're all competing, right? And so they have slimmer profit margins, but they still make money. And they still want to, labor just gets a bigger slice of the pie to a certain extent, right? Definitely the average McDonald's worker, I think in Australia can afford more McDonald's, right? Than the average McDonald's worker in America.
Well,
If
so
they
how
wanted to
mu-
spend it.
Austin, how much is like a Big Mac meal in?
Hold on a sec. Hold on a sec. I'll look it up so I get it right. I have to, let's
So there's two inflationary mechanisms that you have to keep distinct, and I think the one you're thinking about, Brian, is the capacity constraint inflation. And so with capacity constraint inflation, the question is, say your McDonald's workers, all your McDonald's workers start making 4 times as much money, but the question is, does the economy have the output for them to be able to spend that money and get real output for it at stable prices, instead of having them spend the money and there not being enough output or room for output to grow, and you end up with just them getting the same amount of stuff but paying a higher nominal price for it. So based on capacity utilization, that's really low. But the thing is that the current inflation that is occurring, which is temporarily, maybe temporarily at 5%, that is not due to capacity constraints. That is actually the beginning of asset inflation turning into loss of faith in the currency.
There's also some supply chain issues there too, right? And some scarcity driving up prices.
There is some supply chain issues, but a lot of it, the business owners are saying that a lot of them are finding that it makes more sense for them to keep their capacity offline and just raise prices, and they actually make more money when they raise the prices than they would
artificial scarcity
online. The problem is that with all of the extreme asset inflation, you are this bubble of savings over here, this savings glut, it's kind of gushing out in every direction. It cannot find investment. Instead, it's sending the price of Bitcoin up. It's sending the price of GameStop and AMC and whatever and NFTs. It's sending the price of everything up, and eventually. And eventually part of that includes like commodities. So like the price of lumber and stuff. Those are also affected by commodity markets, which are affected by financial market activity. They are susceptible to speculative bubble due to savings glut with no productive outlet.
I mean, yeah, they're affected in some non-zero way. But like the lumber issues and things were more supply chain problems, when the lumber mills shut down at the start of the pandemic, well,
those two are a little bit difficult to separate, because on the one hand you have supply chain stuff going on the other hand you have a pool of lumber traders who are watching the supply chain, but they're also watching the market prices and trying to predict the future, and they're also buying and trading based on what the prices are doing. And so you can potentially have traders sort of longing up, buying up commodities because it's profitable for them to buy them up, take them off the market, and sell them back to the market in the future when they can get more dollars for them in the future than they could in the past.
So, all right. Well, that was an interesting, interesting thought. Hey, Austin, did you figure out how much a Big Mac meal costs in Australia?
A
I'm so
large
curious
Big Mac
about this.
meal in Australia costs $8 something in US dollars if you translate it. So it's 11 US dollars, which is $8 US dollars for a large Big Mac meal in Australia.
How
Okay.
much is it? in
Yeah,
States?
$8 sounds about right.
Thank
here,
you.
too. And when I
Yeah, I
worked for
guess it would
McDonald's,
depend
it
on the
used to be
state there.
$2.99.
I was about to, thank you, mate. Sorry, just a courier came. I was about to look up the US, but then I was like, does it differ from state to state in the US because you have different minimum wages, or is it the same countrywide?
It's
It's-
different, a little bit different state to state.
Yeah.
Okay.
so, All right. Well, thanks for the conversation tonight,
Thanks
guys.
for the
Yeah.
discussion. Yeah, see you guys
Always a
all.
pleasure, guys. Sorry, I
Thank
was
you.
late to start.
No problem.
All right.
Yeah.
See you guys.